Debbie Marcoux is licensed by the California Department of Business Oversight under the California Residential Mortgage Lending Act, NMLS ID 237926. Also licensed in Arizona, 094-1504, Georgia 69178, Illinois 031.005-8339, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington, MLO 237926, Heidi Slade Points, California, DBO 1666881.
She's the mortgage mom. She can get things done. When you're in need and don't know where to go, pick up the phone and call Mom.
All right, well, welcome to Mortgage Mom Radio. I am Debbie Marcoux, and I have got a fantastic guest with us today. I've got Cameron Robinson with me. Say hi, Cam.
How are you?
I am great. Cameron, I have been promising all of my listeners for weeks now that I was going to have an appraiser on with us on this show. And I think that it's really, really important based on the market and where things are at that they get a perspective from, an appraiser's view. We've got refinances that are happening and lots of home improvement going on. We've got purchases that are crazy busy at the moment, not enough inventory, multiple offers on every property. And really what it comes down to once we get into the process is that appraisal. It's such a big piece of it. And for a refinance, for a purchase, for both kinds of transactions. So I have been promising, and obviously you appraisers, man, you guys are hard to get a hold of, but I got you. I got you here. So this is Cam Robinson. Cam, what is the name of your appraisal company?
RR Appraisals Incorporated.
RR Appraisals Incorporated. And what I love about Cam is that he works with his dad, and that is how the family Mortgage Mom Radio business works as well. So you guys are fantastic.
Been in the business for a long time.
Yep, you guys are fantastic. You and Rex are amazing, and thank you so much for coming on. I know it's going to be a great show. I know you're going to give lots of great information to everybody, so thank you so much for taking the time. I know, like I said, I had to hound you quite a bit.
You did, understandably, and I apologize for being so busy, but that's the world we're in at this current moment. So I'm glad we were able to work it out, and hopefully we live up and can get them some good information.
Oh, absolutely. So this is Mortgage Mom Radio. We bring everybody all of the education, information, advice that we can. The goal of the show is to help educate borrowers, buyers, anybody real estate, mortgage related, to get through the transaction, make things just a little bit easier. And we're being watched right now on Facebook, and we're being watched on YouTube. So if you guys are watching us, give us a big thumbs up, put something in the feed, let us know you're here and that you're watching, you're listening. If you have not already, I learned something new with YouTube, Matt.
Oh, yeah?
I did, because, I've been all into this Bitcoin lately. Everybody's on a big Bitcoin thing, right? So I've been watching all these videos on Bitcoin, and these, they're so energetic when they first come on with their, live streams and stuff. But they keep telling everybody, make sure, you subscribe to the channel and you click on the notification button, which is what I tell everybody for my YouTube page. But when you click on the notification bell, you have to actually click all. If you don't click all, they won't actually get the notification that we're on.
Oh, wow.
And I didn't know that. So I'm learning. All of you guys watching on YouTube, thank you so much. But make sure you click that all button. How are we doing? Do we have anybody saying that they're here right now?
Our very own Heidi says, hi, Cam, and hi, Deb, I'm here. And Deborah on Facebook says, good evening,
Hello,
Debbie.
Heidi.
You look very nice.
Thank you so much. Hi, Heidi, and thank you so much for Debbie. That was so nice. So again, if you guys have questions at all that you want to ask Cam, please throw those into the feed. If you guys are listening to us on Saturday morning on Go Country, you guys can always check us out live Wednesdays at 5. That's where you guys get to put your questions into the feed, and we're going to answer them for you right there live with your questions. One thing that you can't see if you're listening on radio is you can't see what I look like. You can't see what I'm wearing. And I got to tell you, I'm actually wearing a pretty explicit t-shirt today. Holidays are coming. Christmas is around the corner. And this is my Christmas vacation shirt. We're not going to read it out loud, but we are the jolliest bunch of you-know-whats this side of town. So anyway, all right, so let's get into some great stuff. We're going to talk with Cam all about appraisals because we do have a lot of things happening right now in the market. So number one question I do have for you, I heard this from a different appraiser not too long ago, and I don't know if it was true, so I thought, you know what, I'll ask you and see if you're feeling the same thing. I was told that about 65% of the appraisals that he has been doing are for people that are leaving the state. Are you getting that at all?
Yeah. So 65 feels a little high. Of course, these are not scientific,
Of course, no.
surveys per se.
Yeah.
But it feels like 50% of the purchases that we're coming in to do an appraisal for, the people are leaving.
Wow.
I researched this a couple weeks ago. I can only keep so much in my head in a weekly basis here, but I think it was in the range of 30 to 35% has been confirmed that are actually leaving. So I don't know if that's statewide, maybe because of where we're at, a certain amount of people are leaving. I'm sure those statistics vary based on the location in LA versus, maybe something in Kern County, a little more rural or whatever. But yeah, it's certainly something that we are seeing. I tend to ask the owners when we come in, and like I said, it certainly feels like, and maybe 65 is more correct, but it certainly feels like at least one out of every other house, someone's leaving the state.
Wow.
Today confirms that. I had,
Yeah.
4 purchases and 2 people leaving, 2 people weren't. So,
So crazy. I mean, I get it. California is expensive. I get it. And we've got taxes and they're talking about making taxes bigger and I so get it. But at the end of the day, we live in California. I got to just say, it's hard to think about going somewhere else and replacing, the weather and, the scenery and I don't know. I guess I'm from the Midwest originally, but I'm definitely a Cali girl, and I'm not leaving anytime soon. So I might go buy something somewhere else as a second home or a vacation property, eventually where you can go and spend maybe the summer for a month or two. But I don't get it. But I mean, I do, I guess, right?
Yeah. Well, I would say it's. We tend to ask, and of course we're kind of doing a little bit of BS and while we're there doing the appraisal. So I tend to ask people, where are you going and what are your thoughts? And the typical things you hear that are the typical tax havens versus California. You get the Nevadas and the Arizonas and Texas. Those are have been staples of people leaving because they want lower income taxes and stuff. So those are pretty common, but it's funny. Then it goes in waves where you hear different states. Idaho's obviously been a popular one. You hear a lot of Montana. Today, the ones leaving, ironically enough, both were going to Utah. Didn't know each other, so that was kind of entertaining. So yeah, it's interesting. People are making changes for a variety of reasons, I'm sure. Yeah, so it's just funny. I'm not sure if there's any real rhyme or reason, right? It just kind of goes in waves, at least from our perspective.
Yeah. Well, and what's funny is that even with people leaving, I mean, property values are still on the rise, right? So I wanted to say hi to Brandon Wegner. It looks like he came on, said, hi, I'm watching. Thank you so much. Karen, thank you so much. I love that you're here and that you're watching as well. I don't have Karen's my mother-in-law, so I got to say, my family's back at it again. I love it. But usually I've got all the family on, and they're dissing me tonight. I don't know what's going on. Anyway, that's okay. But this is Mortgage Mom Radio. If you guys have questions for Cam, make sure you put those into the feed. Matt's going to read them out loud for us so that we can get those answered for you. Cam Robinson with RR Appraisals, and he's going to talk to us all about all of the good stuff that you need to know. So let's start with purchase, Cam, because I feel like that's really an important piece right now. There are, there's very little inventory. Every single property is going on the market. They're having multiple offers. And when I say multiple, I'm seeing between 10 and 15 offers within the first 3 days of the property hitting the market. Obviously, it's got to be listed. It can't be outrageously priced or you're not going to get that. But when a property is listed where it should be, we're seeing multiple offers very, very quick. And the homes just are not sitting because there's not enough inventory. So the first question that I have for you is I'm seeing contracts, right? I'm on the other end of the table. I'm getting the contract, buyers applying for the loan. I'm reading through the offer. I'm reading through the counter offer. And I'm seeing things written in there like no appraisal waiver, or buyer agrees to pay up to X dollars above the appraised value, before the seller's willing to negotiate on the price. But the last house that closed, we live in California, and there are obviously some custom homes out here, but for the most part, we are tract housing, cookie cutter properties, right? So how are you guys dealing with property listed at 539, property sells for 555? What are you guys doing? How are you handling that?
It's a great question, common question, as you can imagine, and which is why we're discussing it. Um, yeah, I'm going to try and make my answer concise. What we try to do is ultimately our job as appraisers is to try and reflect the buying habits of buyers in the market and consider the typical buyer, right? Not the guy who wants this specific house. He doesn't care what it costs. I'll pay anything, but also not the buyer who's like, I won't buy any house unless I can get it for 25,000 under what they're offering.
Well, that guy's not buying a house right now.
Exactly.
Yeah.
He's renting for a while.
Right.
So when that's what we mean by a typical buyer, right? So they're out there shopping. They're looking at stuff within a certain buyer segment or in a price range, and so they'll just go kind of visit. Right now, they'll obviously go kind of visit any property that's in that buyer's range. A typical market, when you have enough inventory, is going to have buyers and sellers be kind of more on a level playing field, right? Sellers are competing against other houses. Buyers are competing against a normal buyer pool. Maybe one other person wants the house. If not, you're like, oh, bummer, we'll go look at this other one that we wanted to look at anyway. That's what's different about right now. A buyer walks into a house, maybe before there was a specific development or two that they really liked, or they really want to be in that area. And, right now, there may only be one house between the two areas that's available for that's an active listing. And chances are, if that's the case, they're walking into already having that house already receiving a bunch of offers. So that's the buying patterns, and the buyer habits are a little bit different than a normal market. You have buyers who are willing to pay, in some cases, full price, exactly the same as the last house that sold, but that house was totally updated. This one isn't. But they don't care. They're willing to pay a very minimal amount different, if not just same in some cases we have seen, because if it is in an area, they don't care what it looks like. They don't care how much work it needs. They've lost 6 houses already. They'll pay 25 over for this one, no matter what. So it takes some extra research, and just a little bit more explanation to try and explain that the buyer habits and patterns are different than a normal market. And what we have to remember, and I think some appraisers forget, we have to remember that our job is to appraise a property, whatever the date of that appraisal is, right? So if someone next week, it could be the Monday of next week. So when we go and we see the property, that essentially establishes our effective date. So when you have the situations that we have now, we are able to expand our parameters to try and better reflect that people are not just looking in one tiny little 1 mile radius. There's a good chance they saw a house in Valencia. They also saw a house in Canyon Country, and they also looked at a house in Saugus. Now, I'm not saying in every appraisal we have an appraised, a comp or comparable property from, 10 miles away, but people are not just, normally there's like a geographic area they're trying to get into. I think right now it's pretty easy to see that most people have expanded that geography and expanded maybe what they're looking for. And so therefore they're willing to pay, in some cases, like I said, full price for something that's not updated. So really what they do and what we try to reflect is we try to explain if there's, 10 people putting in offers for a property, and the lowest one was 12,000 over asking, the highest was 35, we don't necessarily want to come in and just be like, nope, sorry, what they listed it for was perfect. That was right on. You guys are all paying extra money, or the deal's dead, or they're moving to another buyer. And I'm not saying everything is justifiable, but we try to look at it and explain in our reports that, look, people are willing to pay the reason they're willing to pay this, if you see a comp here that's maybe 2 miles away now, they also probably would shop in this area. And you're seeing, due to this lack of inventory, kind of an expansion of the normal radius search that we do. I know that was a bit long-winded, and I'm sure we'll go into some of those details, but in short, we're trying our best to reflect what the buyer pool is doing. Right. And every appraiser is going to look at that differently and review the data and come to their own conclusions. So I don't want to make it sound like everyone agrees exactly with how we're saying that. Some people may only stay within that development and try to stay right in there. That could be from what lenders that they've worked with that maybe say, no, we're not doing any of that. But at the end of the day, it's our job to try and come up with a good report that's defendable and pass it to the lender. And if the lender wants to fight us, we should be able to defend our position and say, no, this is, our job is to reflect what the buyers are doing, and we feel pretty good about this report. I know it seems higher than you expected, but that's also, what the buyer felt too when they were buying the house for more than they expected.
Right. So basically, I mean, you guys have some sort of variance where you can go up from the last cookie cutter house that sold on the street with the same size lot, both had a pool or whatever was going on. But you've got some sort of variance that you can go up for market condition.
Yeah. So, and it has to be, I want to be clear, because I don't want people to think we can just pick a comp anytime it's higher. Yeah, no, so, okay, I'll go find the higher comps, disregard everything. That's not, there has to be a justification for it. And in this scenario, in most cases, it is because there's, if a buyer's willing to pay $25,000 over this house and the last one sold for, 10, 15,000 less than that, how can you justify that? And it's like, well, these people were as aware of that comparable as you and I are. And they saw that and they were willing to pay this. And guess what? They were one of 12 people willing to do that. We have to try and justify it as best we can to say, okay, well, if, clearly they saw that comp, that would be included in the report, and then maybe some other comparables from the buyer pool and segment that they're in, and try and say, look, you can tell from some of these other comps that when they came in and wrote this offer, the value is actually not that far off. So, or it was right on. So, and this is our office personally, but what we try to do is when you have 10, 15 people offering over asking price for a property, that's a pretty strong market indicator. It's not our fault or job or anyone's problem that there's nothing to buy. I mean, that's the market indicator, and the market factors are the market factors. So it's not our job to dictate what the market is. It's our job to say, look, the market factors are what they are. There's 15 people willing to pay over asking. So, we try our best to reflect the market as best we can. Whereas, in comparison, if you had a house that's been on the market for right now, 30 days is a long time,
Right.
But let's just say for, 180 days or something like that. And their starting point was way higher than what most would consider, okay, but they stuck to it and finally found the one guy or girl who's willing to buy it, or family or whatever, and said, yeah, we'll give you that. That's not as strong of an argument for true market value. You got one person willing to buy that one house. That's, there's usually going to be some arguments against that. Whereas now, every house we walk into is 15 people who tried to buy the house, so it's a hard argument to say, nope, sorry, it's not worth that, when you have 15 people going, I'll pay it. I don't care. I'll pay it,
Right.
So it's, at the end of the day, we're supposed to, market value is determined by supply and demand, economics 101. And then our job is to try and reflect that market as accurately as we can. And that doesn't always mean that we can appraise the house for the price that someone offered, but we always try to. I think most appraisers understand what sort of ripples are created in the current, or in the water as soon as we aren't able to justify a sale price.
Right. Yeah. No. I mean,
but it does happen.
It does. And especially right now, I mean, I've seen properties go $50,000, $60,000, $70,000 above where they were listed at. And sometimes it's just not possible for you guys to be able to justify and to bring that appraisal in. And that does bring everybody back to the drawing board. It brings the buyer back to the drawing board, because obviously their down payment now isn't the same percentage that it was before, because now we're looking at a lower value of the home, even though the sales price is higher. So, it definitely does create that ripple, like you said, and it does make a big difference. And so that's why I thought it was so important for us to really kind of zone in on that first key question, because we're just seeing so much of that right now. It really is something that we're dealing with on, a daily basis with these purchases. And, we've been very lucky, that there are a ton of appraisers that are fantastic. Like you said, you guys are trying to do your very best to bring it in, where the buyer is willing to pay for that property at. But obviously at the end of the day, you can't go, so far out of tune that, it's really not justifiable. So I do like that you guys are also counterbalancing with like, hey, we have to make sure that this is making sense as well.
Yeah, and that's another thing. We could get into this maybe later if you want to. I don't want to get too lost in the weeds for the people listening or the people that are going to hear this, but really something to keep in mind is the appraisal itself, and let's say you get your appraisal back and it comes in at the value. You can't believe it. Everyone's excited. off we go, right? We're going to get ready, call the movers, honey. We're getting ready to do everything. We're in the final home stretch. One thing to keep in mind is that our appraisals get scrutinized far more than they ever used to. So as soon as our appraisal comes in, everyone may be excited. Maybe we feel like we have a strong, justifiable report that brings it in $25,000 over the asking price, but we feel the report is actually justifiable and we can defend it if someone were to question it. What people need to understand is there are processes that happen after our appraisal is delivered that review our report. One big portion of that is from Fannie and Freddie themselves, who whether your buyers know or your listeners know, basically own 75% of the mortgages in the country, maybe more at this point with all the quantitative easing. So that's one big, a review system that looks at our appraisal. And then there's another one, obviously, which is your underwriters. Your underwriters may look at that and not really agree with how we cut from point A to point B as well. So we have had appraisals where, we sent them in and we thought it was a good report, but this system from that Fannie and Freddie run every appraisal through did not agree. I want to be clear, it's a computer system, so we have our own quarrels with that, and that's another discussion. But if it doesn't rate our appraisal in a good light, usually what that triggers is what's called some sort of follow-up, either field review or some sort of review of our appraisal from another appraiser.
Right.
And so it can get cut. Our value can get cut by that other appraiser if they don't agree with it. And, even if we feel we have a very strong argument in our favor or we can defend our report, 9 times out of 10, an underwriter is going to go with the lower value just out of conservatism anyway.
Yeah.
So those are things to think about.
Yeah, no, and I'm happy that you brought that up because it is something that is very important for everybody to understand. I mean, this show is all about the education, the advice. We're teaching you what happens in the process of a loan. And one of the things that does happen is even though your appraisal comes in, like Cameron said, it's going to go through underwriting, and the credit underwriter does have to review that. And, they could very well cut that value, or there might be repair work in the appraisal that needs to be taken care of. You guys saw some health and safety issues or some, mold, or you saw some roof leaks, or, you saw some things that would cause some concern that need to be checked out, that the appraisal can be subject to either those repairs or some sort of an inspection to verify that there are no active, issues or roof leaks or, things that could be happening. So it is really, really important that you are communicating with your lender, because when that appraisal comes in, you're going to get a notification, hey, here's a copy of your report, but you need to make sure that everything's been signed off, it's been underwritten, it's been approved before you go ahead and you remove that appraisal contingency from your purchase contract. So just kind of want to throw that in there since you happen to bring that up. It's again, all about just kind of teaching and training and educating.
Yeah. Sorry, I hope I did. And that's a whole complicated. We could spend an entire show talking about that. So I don't want to. I know I don't want to get lost in the weeds on that.
No, it's okay.
I'll go as in depth as you would like. You tell me.
Yeah.
Got a couple comments on Facebook. Chris says hello, Debbie, and Aunt Lori says I'm here, having a hard time on YouTube. Moved over to Facebook. Deb, your hair is so cute.
Oh, well, thank you so much. I appreciate it. Hey guys, wherever you guys want to watch us, you can watch us on Twitch. You can watch us on YouTube. You can watch us on Facebook. Make sure you guys are liking the page, subscribing to the channel, turn on your notifications. And like I said, I just learned a couple days ago, you got to hit that all button to know when we are live. So make sure you guys do that. I've got Cam Robinson with RR Appraisals. He's on with us right now, educating us all about the appraisal process and how things are rolling. So if you have any questions whatsoever, get those in the feed. If you guys are watching, you haven't said hi already, please feel free to do that. I want to know you guys are here and you're checking it out. So Cam, let's move on. And that was purchase, and obviously we'll get back to purchase because I want to talk to you about closing cost credits and all that good stuff. But we'll get to that. But I want to talk about refinance for a minute. And I want to talk about, because a lot of people right now are doing home improvements. They're not selling their homes, which is why we have a shortage of inventory. They're all staying home. They're saying, hey, we've got to live in this house. We're working from home. We're teaching our kids from home. We're spending day in and day out in this property. We need to clean it up. Mm-hmm. It's time. I got to do my kitchen. I've got to, we've got to put in a new roof. Maybe it's time for some solar panels. I want to rewire the house with internet so that we're not on Wi-Fi. We want to be hard connected, right? So they're doing a lot of work, a lot of home improvement. And I want you to talk a little bit about how home improvement changes the value. And again, I'm not talking about, custom homes and custom properties. Obviously, there is a lot of that everywhere. Anybody that's watching me right now, it's not just California. It's not just Santa Clarita where I'm based, you're based, right? But, we're all across the country. People are watching the show, they're listening, they're tuning into the podcast. But here in our direct area, Arizona, Nevada, Washington, a lot of the areas where we're doing a lot of business are cookie cutter tract housing. So if you have somebody that is, and you mentioned, about that purchase, they're going to buy the house that wasn't upgraded, even though the last one was, and they're going to pay more for they're paying almost the same price for the property, but it's still original from, the 70s. Let's say somebody goes in and they just completely update the house everywhere, drop $100,000 into this, tract house. How does that really work out for you when you're doing that appraisal? How much really can you give them? Because I know it's not dollar for dollar.
Totally. That's a very good question, very fair question, and obviously a very common question, especially from the people who just dropped $120K doing their house. So the way I like to describe how we look at upgrades or updates is this. I tell people the easiest way to explain it is we basically separate houses into kind of 3 different categories, right? So your lowest category are going to be houses that, this is your range in that lowest level. You're going to have stuff that's dilapidated, needs a ton of work. This is probably an investor purchase, but sometimes a family will buy it and want to spend the money to do it and take advantage of the equity once they've done so. But a house that probably needs a bunch of work, hasn't been painted, hasn't been updated, all that stuff. So it needs repair and it hasn't been touched, is probably going to be at the lowest end of your sales spectrum. Then in that same category on the higher end, it might be a house, like you said, built in the 70s. Maybe it's original, well kept though. There's not you don't have to move in and fix a bunch of stuff, but it's just dated. Right. So that's kind of that range.
Yeah, you still got your shag carpet and your orange, appliances but it's all working.
Grandma took great care of her shag carpet and you'd have to replace it.
Right. Your swamp cooler.
So that's kind of that lower. Exactly, swamp cooler, but it hasn't been used a ton. Maybe they didn't care, so it's in good shape still. So that's kind of that lower tier, right? Then you're gonna have your middle tier, which I would say most homes usually fall somewhere within this tier, and that's where you're gonna have houses that have been, well kept and have some updates. We just put all new flooring in, but you haven't touched the kitchen or the bathrooms. Think of stuff like that, and that's what most people do because they kind of do updates here and there.
As they go,
when either they need to,
right?
Yeah, and when they save up enough money to do it, right? Not everyone's ready to just drop $100,000 on their house all the time, so they might do the flooring when they make have a good year in business or at work, and then maybe the next year they plan on doing the 2 bathrooms, that sort of thing. That's kind of what in that middle tier. You're going to have houses that are generally, have some updates, in good shape, don't require really a lot of repair. And then the higher end of that middle tier will be houses that maybe were updated, but maybe 10 years ago, 15 years ago, right? So you can tell usually trends change. We all know that.
Whitewash cabinets aren't cool anymore, but they're probably in great shape. Yeah.
Exactly. But in good shape, you can tell they put in their granite, 10 years ago, but it's nice. It's not, but you can usually, if you look at a lot of houses, especially as a buyer, you probably start to recognize some of the decades of when certain things were installed. You'll notice it like we do.
Right.
And then obviously you're going to have your top tier, which are houses that, essentially are going to be at the top of the market, have the most updates, if not completely updated. And that's going to be kind of in that the highest tier of valuation. And so the reason I explain that is because, it's really hard. I wish we were this good, but it's really hard for us to go say, hey, I had a guy tell me today, really nice guy, doing refinance on his house. It's like, hey, I just put in all these new windows. I just put in these new gates and these new fences. And in my head, I'm going, that stuff's all great and makes it, the house is awesome, looks great. But, for us to give a straight adjustment, quote unquote, which is something we have to get from the market, we wouldn't just give you an adjustment for having updated windows and a new fence. Now, I'm not trying to say don't do that and that stuff's not important. I'm saying we look at stuff more in an overall condition idea. And like I said, I wish we were so good and the market provided us with enough data that we could kind of make adjustments on a dollar for dollar basis or stuff like that.
Right.
But it's just not really realistic. Because as soon as you make an argument for the adjustment, I can probably give you 5 against it, or give you 5 comps that say it didn't mean anything. So I know people don't like to hear that. I try to explain it that way in the nicest way possible. The other thing I like to tell people is don't look at updates and everything on your house as like, if I spend, $2,000 doing this, our downstairs bathroom, how's that going to help my value? It's not really like that. Think of first of all, nothing's dollar for dollar. Almost, and everyone knows this, the pool is the easiest way to explain it to people who aren't in the business. If everybody it's common knowledge that you're going to spend $100,000 on a mediocre pool, right? A decent pool, nothing crazy,
right? But
not a cheap little tiny pool. You'll spend $100,000, no problem. And they know not going to get $100,000 in the market. Your house doesn't go up $100,000 when you do that. So I use a pool as an example because it's such common knowledge that, like most updates, you are not going to get your money that you spent out of that in full. Now, that being said, what I tell people is think of moving your house from tier to tier. That's how you will get the most bang for your buck, right? That's the easiest way to explain kind of how the update thing goes. And of course, if you're in that lower tier, you're going to have a lot more of a chance for improvement because you just have more improvements to do and higher, more of a range to kind of slide up. If you're already near the top, let's just say your house is, we did a house the other day that was totally updated. Everything was in great shape, new flooring, new paint, the bathrooms are redone, but they hadn't touched their kitchen. That was the last thing they were saving, right? And understandably, because usually it's the most expensive, So that's the type of thing where we might look at the kitchen, because the kitchen being such a big ticket item typically to update, we might make an adjustment on condition for something like that. Let's just say 5,000 or 10,000 or something like that. But, there's just not enough.
Yeah. So I guess, like, what do you really see though? Like, let's say that you've got a house that is in the top tier. I mean, it is just beautiful. It is Ritz-Carlton'd out. You walk through the door and you think somebody's going to hand you a towel to wipe your face, right? Or to put the booties on your feet. What is the difference between that house and your middle of the road average, has kept it up, updated the bathrooms, hasn't done the kitchen yet, but it's got new floors? What are you really getting the difference, right, between those homes? I mean, how much really can you go up? And I'm going to explain why I'm asking these questions, but what are we talking, a percentage or a dollar amount? If you've got one house on the street and the identical house and you've got the two different categories, assuming that everything else is the same floor plan, same exact pool, same exact landscape, same everything. Are you talking 20,000, 10,000, 30,000? How much room do you really have that you can change that value?
That's a great question. I'm going to answer it as unambiguously as I possibly can.
I love it.
Which is basically a disclaimer that it's going to be somewhat ambiguous.
Right.
What we would do in that scenario, or really in any scenario, is we should do our best to try and find some comparable that is similar to house A versus, compared, and house B, really, right? And so if you have two closed sales and you can see really directly in the market, hopefully not too different from each other as far as the dates of sale, right? Because we know the market can change pretty quickly, especially right now. So you're hoping they're within a month or two of each other. And then you can really try and extrapolate from those